I think we have the largest open Ponzi game when it comes to Microstrategy. It's just an open Ponzi game. Everybody needs to pile into him to the stock, and then he can take on some more debt and he buys more Bitcoin, and he doesn't expect it to decline. And then if I get what I'm talking about with the 120 on the Dixie, I can promise you Bitcoin is going to take a beating. And if you see the largest bubble in the world, the Nasdaq, declining by 85%, which it did into the 2001 bubble after that, which is a smaller bubble than what we have today, well, Bitcoin is going to have a really, really bad day, a bad period. And then that means that, MicroStrategy is going to have that. So I think it's the largest house of cards we have seen in a long time. And if that starts to unwind, what you just said there, well, it's going to be really, really bad for people who think that can just hold on to it.
Hi everybody, my name is Paul Buitink and welcome back to Reinvent Money, a show about money and power. Most of my guests expect the market crash, and today's guest expects that too, but he still sees plenty of upside before the mother of all bubbles will burst. And I'm happy to welcome Henrik Zeberg to the show. He's a macroeconomist at Swissblock to discuss this interesting topic. Hi Henrik, welcome.
Thank you very much, Paul, for having me on today.
Yeah, first time on the show. I've been following you for a while, and you have some interesting views, especially when it comes to timing the market. Like I've had a lot of bears on the show. People were quite somber and pessimistic about where markets are going, and they expect lots of crashes to take place. You're also in the long run bearish, but in the short run, you still see this market develop much more. For example, stock markets in the US, but especially basically across the world, real estate markets, crypto markets. So first question is, why do you think prices are going to get higher much more over the next few months?
Well, firstly, because we don't have the economy is not breaking down to the point where we get a crash. And this is what people need to understand, is that a crash doesn't come out of thin air. It actually comes out of a situation where the environment in the economy is getting toxic, and then you'll see that all of a sudden you have the deterioration in the economy, and you have the deterioration amongst the consumers, and then you'll see that all of a sudden the economy starts to run backwards because businesses will start to lay off people, and we simply don't see those signals just yet. We don't see it in the yields, we don't see it in the yield spreads, we don't see it in initial claims. So even though we have a lot of structural issues, there is a structural hole in the ship here. The Titanic has hit the iceberg, but it's just not sinking just yet. That's simply the difference. I mean, if people think that hit the iceberg and you go straight down, the situation is that the music is still playing and you can still get a drink at the bar, and people really do not. And actually, you said that a lot of people are expecting the crash. I can tell you, most people actually think that, this is just over. That's not going to be a crash, because why would you have that now? Now the tariff thing is kind of landed, and there's not the worries that we had. So I think I actually meet a lot of people who think that I'm just crazy when I talk about a crash. So I think the situation will be that the market actually always trying to make us, the most people, look foolish, and I think right now we're in the situation where we're probably going to see more upside because the economy is still strong. You get a liquidity now coming in from central banks from around the world, and the Fed is also going to has kind of pivoted already and is signaling also that they want to support. But I don't think we're so far away in terms of time. I think it's more of the last move. And if you look back to 1989, where you had the last move in the Nikkei market, you actually saw that within the last few months, you had some extreme rallies or gains in the stock market. And we are in that phase. You can simply take the chart of the Nikkei and see how it's first, had a kind of an angle, and then it kind of increased, and then, it went sort of straight up. We do have the largest bubble ever. There's no doubt about that. I mean, you can just do the market capitalization to GDP and so on, and you can put crypto on top of it, and you can put the housing market. So everything is set for a crash, and we're going to set for the largest crash I think you and I will ever see. But we're not there, simply, and there's much more upside, and the liquidity part of it and the FOMO part will drive a lot still before we get to the point, and we need to get everybody over on the other side of the, so to speak, of the fence, and say, well, all is good and we'll just continue up because the Fed has got our back. And we don't have that sentiment yet. It's always the Fed's got our back. When I start to get those comments to my bearish outlooks, then they'll say, "Oh, Henrik," then I know that's we're getting close. We're not there yet, so we simply need to see more upside.
Yeah, maybe it's also my own bias or bubble in which I interview people where most people are bearish. But you probably, as an investment manager, you talk to all sorts of people, and also I guess a lot of fund managers and pension funds perhaps who still think everything looks fine.
Oh yeah. You have the majority of those I speak to are think that things are fine now, and why would we worry about things? And if you say that prices are a bit high, and you have the look to various ratios, they'll also say, yeah, but maybe they don't apply any longer, and maybe it's because actually the U.S. market is now so much bigger, compared to the rest of the world. So they kind of put the cart in front of the horse and try to turn the narrative around instead of just concluding what is the most obvious thing is. Yes, we have a massive bubble, but the market can stay irrational longer than you can stay solvent. So that's why I'm absolutely not shorting the market at this point. I think it's going to be quite a ride to higher, and driven by FOMO, driven by greed, but again, the rational investor, the Warren Buffett, is pulling some or taking some chips off the table and saying I've seen enough. And he's up to 30%, I think, in terms of cash in his on his
record
balance,
amount
right?
of cash he holds, right? So he
cash.
clearly expects a correction then, or he just can't find any interesting opportunities in the markets right now. But
correct.
Like some of these people you talk to, they do agree that valuations are extremely high, but they say, look, this time is different, and maybe these models don't work anymore because there's just still a lot of other money that has yet to flow into markets, or that they find reasons to
They'll
basically
talk about
ignore
AI.
those metrics.
AI will help it. They'll talk about crypto. They'll talk about stable coins. They'll talk about liquidity. The Fed will not allow it. Trump will not allow it, and all these. I love this about allowing it. Which president would ever allow it to see anything decline or crash?
Yeah, because does the Fed have that kind of power? I mean, of course, the Fed they have bazookas, they have a balance sheet, but can they do anything about a potential collapse?
Of course, the Fed will try to do something, but the only thing they can do is try to loosen financial conditions and support with liquidity. And the thing is, we've gotten used to that liquidity can solve everything for the last many years. And every time we had a problem, we just poured some more liquidity on it. Then things were fine for a period. But the problem is that has changed. That is actually the one thing that is different this time around, which is that we've seen a seismic shift in the inflation regime. So since 1981, we have had a deflationary regime, which means that yields were going down. No matter what we try to do, we could throw money out the window, and yields were just still going lower. Inflation was going lower. And then we had the COVID situation, and the central banks came out and they stimulated the shit out of things with just to get things started, they thought. But again, it was actually a supply crisis. A lot of people had to go home because they couldn't go to where they worked, and which means that the supply chains actually started to break down. And then you give everybody a paycheck, an extra, fiscal stimulus, and you lower the interest rates, and everybody had a lot of money in their hands. So what do you do when you get a lot of money in your hands? You spend it into a supply chain crisis. I mean, supply and demand, supply is diminishing and demand is rising. What do you get? Inflation. And all of a sudden, and the Fed were not really on top of that because they did not expect inflation to go up to 9%, I can promise you. And then they all of a sudden, oh, now we need to be all hawkish on things. And then they start to be very hawkish on things, and they are now again into the very big policy mistake here. So things are as they normally are. And I think we will have some more time. They will try to do this again. The problem is just that, and that's the point actually of what I was talking to here, is that this time around, they actually managed to bring inflation out. And if you look at it in a very long-term time scale here, you can actually see that there is a shift in the 10-year yields in terms of momentum. It's something that this chart I brought up quite often. And if you look at that on a 3-month basis, you can see that shift has only happened 4 times since 1920s. We have a shift now, which is remarkable, doesn't mean inflation will go up from here, because inflation always goes in a trend, but ups and downs, and it goes down in a trend like ups and downs. But the shift is to now that we have a change in the regime coming from a deflationary downward pressure on inflation and yields to an upward pressure. And what happens then if the Fed comes out one more time and pumps money into the system is that they will get what our parents and grandparents that knew, that if you
Inflation.
pump inflation, yes, I mean, that's when the 60s and the 60s and the 70s, they knew that. I mean, if you pump money into the system, you're going to get inflation. But we've just been taught that inflation is something we are now on top of. Guess what? It's here again. It's the ghost. The genie is out. It's so clear it's out. That's all. Jeff Gondlach also said that, well, now he's starting to short bonds. I think it's a little early. Let's be clear on that, because I don't think yields will go straight up from here. Actually, on the contrary, I think they're going to decline first. But you are seeing a new inflationary regime, and that is the problem. And that means that the tools of the Fed will become impotent. They won't be able to just use it. They won't be able to try to stimulate and get the trickle down effect. So there will be, and that's the problem for the Fed, because for quite some time they've been able to at least somehow create a trickle down effect. So what do I mean about that? If they lower yields, they'll see that more money will flow into the markets, and then you'll see that the asset prices are pumped, are moving up, and people feel more wealthy, and they'll start to spend money, and they can get all of that. We saw that 2008. We saw it also somewhat later, but we could also see that there was a declining or diminishing return on these pumps of this kind of trying to stimulate in that manner. The problem is simply now that this will turn against them. So if they try that now, it will turn against them, and they're going to create inflation. They may create an initial bounce in the market, but there's one thing the market does not like. That's inflation. We saw that into 2022. So if I'm right on what I'm saying here, then you're going to see the Fed coming out thinking inflation is under control. We just got the same kind of, let's just pump money. But, remember, they gave Bernanke a Nobel Prize for reinventing money printing. It's the most stupidest thing I've ever seen in my life. But they did that. So now we have this, modern monetary theory, which apparently can save everything from, all crashes. The problem is it's all about the real economy. And the real economy is Mrs. Jensen here in Denmark. I don't know what they called in Amsterdam or
Johnson,
in Holland. Yeah. Johnson, yeah. And especially about Mr. Johnson Mrs. Johnson in the US, where they need to spend, they need to consume. And if they don't, and if they see inflation, that's going to put consumption under pressure, which will be the problem. So you have a situation where the Fed is going to do the same thing. I can promise you they're going to come out, but that's going to be the problem. And that's going to be the problem that potentially can trigger a stagflationary phase. So I think you're going to see a recession being set off by a deflationary bust, which means the bubble bursts. And you see markets crashing and so on. And the Fed will kind of say, yeah, they'll try to do certain things, but then they eventually have to come in big time, because they will see, oh, this is going to end bad. And already now I know people talk about inflation. Again, I don't understand where people get this from, because really look at the business cycle. Look at when you have an economy that is declining, inflation goes down.
Yeah, but earlier you said there is inflation. The genie's out of the bottle, and the inflation
secular and cyclical. That's where we need to understand. There's something that is called a secular, and there's something that's called a cyclical nature of inflation. Cyclical can be more, the next few months or year, 2 years, but there's in terms of the long time frame. So this is where I'm talking about. And we all know that in the 70s, the inflation was high, and then it has been low and coming down for quite some time now, for the last 40 years. But if you look back from after the Second World War, inflation was actually very low there, and it went up into the 70s. So this is the secular moves and the long time. But then on that you have the small moves. And the thing is, we need to distinguish between the short term and the long term. Short term, cyclical, I think we have a down move. Secularly, on the long time frame, I think we have an up move. I hope that makes sense. Or how?
Yeah, okay. Because in the long run, we need inflation, because there's just too much debt. I mean, I don't need inflation, but the system needs inflation in order to stay alive.
Yes, I mean, I think you need somewhat of an inflation. You don't need 5-7%, but you need and this about 2%. People think that that's something that's something that's been calculated. It's not. So whether it's 2% or 2.3% or 2.7% is actually not a problem. It's around those levels, it's fine. That's what people can adapt to and adapt to over the years. What we don't like 5, 6, 10%. That's bad. And we don't like negative inflation. So the problem is not right now. That's not the problem with inflation around 2.7%. It's like it's an academic kind of discussion that it has to be at 2%, and we are now doing whatever we can to push it down to from 2.7. That is honestly, as I see it, the hubris of the central bank. They think they are micromanaging inflation here and trying to push it down at a time where you actually see that the whole economy being the consumer, is under considerable pressure, downward. We have
also because
15.6.
inflation is much higher for other than the CPI. Real inflation, what people actually experience in supermarkets, is much higher than the 2 or 3% that central banks focus on.
Yeah, but more like it's been lifted. The level has been lifted, and that's where again you have the stock and you have the flow. And the stock level, it means the inflation level has been raised, so to speak, right? And that's everything has become more expensive over the last 5 years. Correct. But right now, the inflationary pressures are actually to the downside.
Okay.
And you don't.
Yeah.
Yeah.
So that's why you expect the Fed also to cut heavily over the next few months. So next rate decision will be later
September.
This month.
Yeah.
So you expect a heavy cut?
Well, no, I don't expect a heavy cut. I think we are. Unfortunately, we have a Fed here that was talking about a strong economy, even though my business cycle model was telling me that we were seeing an economy that was deteriorating. And then came, was it August 3rd? And you had the revisions on the non-farm payrolls, and all of a sudden it looks like you had almost a zero growth in non-farm payrolls in May, June, and July. They said it was plus 73,000. I'll have to see those numbers, by the end of it. But you had huge revisions on the non-farm payrolls, which means that you actually have an economy right now that is at 2.7% inflation, CPI, and you have that is hardly, creating any jobs. That's not a strong economy. Would you expect that to have the Fed fund rates at the 4.5%? Probably not. Especially not when you see that the consumers are under so much pressure, and you can see that I think it's 15.6% of the U.S. population who have difficulties in just getting food on the table. That is significant. And that is, I don't understand. You see the consumer sentiment. Powell was asked about that in a presser after FOMC. What is it that the consumer does not understand? And actually, I think it's Powell who doesn't understand that the real economy is about the consumer, and that they also need to understand inflation is something that actually follows the business cycle, which means that if unemployment starts to move up, inflation will not be a problem. Not at this point. Stagflation can come, but that's something they need to.
For later. Yeah. So what do you expect the trajectory to be for the Fed funds rate this year and next year? Where are we going to?
Oh, I would like to answer this on Friday when we see the next NFP number coming out here. And again, those are also kind of random, as we can see the revisions coming out as they are so big. But I would think that they're going to do 25 basis point. I think I have to say that. But they could also. I think there is going to be some kind of either disappointment or a shock to the market from the FOMC, and it may be that. It could be they come out and do something more, which actually could shock the market, but they actually understand, we are actually far behind the curve this time. And then they come and do something. They did 50 basis point cut also in 2007 in September. Not my base case at this point, because I simply think that they are a little too rigid. But would it be right to actually start lowering them faster than they do? Yeah. So I think they are trying to do it with 25 basis points. I think they're going to be forced to actually do it more aggressively as they come down into later this year and early next year.
Yeah, and will that then provide ammunition for stock markets and crypto markets to stay in bubble territory, or is that not really of any impact?
No, but obviously, again, it's like, is it the short term or the long term? But you always, if you look at it, you're going to see that when the Fed starts to cut rates, it's normally there where you see the stock market topping out. Doesn't mean it'll top immediately. I think actually there'll be a very, very bullish effect on it in the short term run. You're going to see assets running up really fast, but then there will be the more wise people in the market will start to think, hey, this is probably not a good thing if the Fed starts to cut rates, because that might mean that the economy is in trouble.
Right.
And then it's not just about liquidity, and people have to understand. I mean, everybody says, yeah, but if we just get liquidity, markets can stay high. No, they cannot. And you can just look to 2007, 2001 also, when this business cycle rolls over, when the economy is getting into a recession, which is about business cycles, is about the real economy. Then the Fed can cut and cut whatever they like and want, and they can see M2 moving up, and still you'll see the market crash and crash a lot. So
Yeah.
liquidity cannot save the day. That's what I'm trying
You
to
can
say.
bring a horse to the river, but you cannot force it to
exactly.
drink, right? Yeah. So your thesis that over the next few months we'll still have the bubble, and that you can profit from that. It's purely based on market dynamics, and not so much based on what the Fed is going to do. It's the momentum is there at the moment, and people will probably make sure price will go up even further. But it's sort of, if I understand you correctly, not necessarily related to what the Fed's going to do next, or maybe temporarily it could go because of that a little bit higher. But it's at this point it's not something you are that interested in.
It's always about, to a certain degree, about liquidity. So there's always, why would prices go up? And then it will have there will be a lot of variables that will explain us why they will go up, right? So obviously liquidity, everything else being equal, you'll see the liquidity, extra liquidity will be positive. Yes. The expectation, the anticipation of liquidity will be very positive. And that's also especially what is driving crypto market. That's actually the only thing that really drives the crypto market. So I think you are going to see that it has a positive effect, but it's not the same as, there's also the opposite, which is the negative effect from the real economy, which is not thriving at this point. Absolutely not. And that's why, so the reason why I think you're going to see markets moving up is we're simply not done with this cycle. The economy is not, as I said earlier, we're not seeing the deterioration. We're not seeing the economy rolls over. And that means for as long as it doesn't do that, you'll see that the continuous flow of liquidity can push markets higher. People think, okay, we don't lose our jobs, everything is fine, we can invest money, and that things will just, and it's a self-propelling kind of cycle. So would it be nice? Is it from fundamentals perspective a good idea? No, it's not. I mean, you just look at the price earnings and look at the market capitalization to GDP and so on. It's an extreme bubble, but it doesn't mean it ends here. And I have 7,500 or maybe even 8,200 around those levels for the S&P. So you have quite a distance you can go into the last phase. And again, I want to remind people of the 1989 bubble in Japan, because that's similar to what we have now, also on the housing market.
Yeah, we're talking about the end of the cycle, and afterwards we can talk a bit about what's going to happen next. But so you're saying S&P can go up? It's now 6,400, so it can easily go up with another 40% or so, 30%. Bitcoin is now at around $111,000. What's your price range for Bitcoin in this final stage of the bubble?
I see at least 140,000 in actually in this next move we're going to see. I think it's going to come pretty soon, and then I think you're going to see somewhat of a pullback. But I think it probably going to find a top somewhere around 165 to 170,000, maybe 175,000 in that area. And that's not, again, too far out. We're talking about something that can happen really quick into the final phase of things. So I just want to caution people on this, that the Bitcoin is just going to go up and up. It's not. It is a risk asset, and it's a very volatile risk asset.
And Ethereum, it's now around $4,360.
Yeah, I think Ethereum actually has such a long way to go still, and I got a target around 17,000 on that, and not in a straight line, but it's just the ratio to what we see with Bitcoin. You will normally see also, especially when the alts phase or the Ethereum phase we're in now, that the ratio will improve quite a lot. And there is a level that says that we can get to around 0.1, 0.12-ish on the on that Ethereum ratio, and that means that Ethereum should go to around 17,000. So I think we have, as I said, we have quite some distance to cover still before we get to the top. But that's not the same as it's going to last for a year, because we have to understand that when things are moving in crypto and into the final phase of a bubble, it can be very, very fast. And it's really about watching for one thing, and that's the dollar. The dollar is the one thing that I'm keeping an eye on in terms of when that makes it the bottom. I think it's about time to find the exit door.
Yeah. Yeah, could you elaborate on that? Because people, of course, when things go wrong, there's a flight to safety, and traditionally, like in 2008 or 2020, people would run to the dollar, and that's something you're going to see again. You think?
Yeah, 100%. I mean, this about that. I mean, in January, everybody was so bullish the dollar and talking about every capital was just flowing into the U.S. because U.S. was the new digital, I don't know, whatever it was. But people had all these narratives. Now it's like, oh, but the dollar now, because the U.S. Place in the world is breaking down, and all these things. That's not the case. The majority of debt in the world is in the U.S. in U.S. dollars. And if we're going to see somewhat of a crisis that I suggest here unfold, you're going to see that all this debt will need to be settled, or not all of it, but debt will have to be settled in dollars. That means there will be a huge demand for dollars for a certain time, and there will also be a flight to safety, because whatever you got to say, it's the cleanest shirt is still the dollar. I mean, I'm not going to keep my money in anything, yuan or anything like that. I'm probably not even going to keep it in the euro, because we will also probably see some asymmetric kind of difficulties in euro as well. So I think the dollar is still the cleanest shirt, even though it's getting quite nasty at this point.
Quite dirty, yeah.
And dirty, yeah. So I think it's just a matter of relativeness to other currencies, and
Yeah.
and that's why I think it will be a dollar's game into the deflationary bust, as I see it.
And most people say indeed the U.S. Stocks are overvalued. At least the people I talk to, you already made the nuance that, like a lot of mainstream fund managers, still think the stock market looks fine, but it's mostly the Magnificent Seven companies that are overvalued, right? There's a lot of small stocks, I guess, with relatively okay multiples still, or.
Actually, I think there are a lot of tech stocks at this point here, that small stocks, tech stocks, that actually have great fundamentals at this point. But you're right. Yes, it's mostly the FANG stocks that extremely stretched at this point, and to the degree also where it's simply creating the whole skew, or the whole distortion of the stock market. So that's why you see that we have the largest tech bubble ever, but it's of course in a few stocks. And Nvidia, like, I don't know how much it takes up. It's 10% of the S&P. I think the value now of Nvidia is just crazy, 450,000 times up over the last 10 years. It's unbelievable. So of course there will, but right now, yes, I think there are some certain stocks that could actually do quite okay into the last phase here, and I think you then going to see that they will then have a final decline also. But some of those actually, and there could be some good opportunities there. But unfortunately, in a crash, the largest crash, the largest bubble, on the crash of that, I think you're going to see all equities, unfortunately, taking a beating in that phase.
Yeah, earlier you said the dollar is something you look for as a signal. If it starts strengthening again, that could be a bad sign. What are potential triggers for the bubble to eventually pop? Let's say in a few months. What are the other things you're looking for? What could be a trigger?
So I don't think there was going to be a one trigger. I mean, that's always what people look for. So when I always ask them, what was the trigger in October 2007, and people say the subprime crisis, and I'm saying that it wasn't really coming out at that point. It was coming out later. So the thing is that you will see that it's the environment that becomes toxic, and the toxic environment is by high yields, high interest rates, as we see right now, and it's becoming difficult for people actually to make ends meet, which means that the banks are starting to see problem, because they'll start to see people defaulting or not being able to pay, and that's what you can see. You can just check that on the credit card delinquencies and so on. That clearly shows the direction of that. So, and then that will create some issues down the road, and then there'll be some businesses that has the same, and that will create larger problems for banks and so on and so forth. So it's about what is going to make the snowball roll, and it's really a lot of things at the same time. So I don't think it's going to be one signal, but of course we need to see some stress in the financial system. We need to see credit spreads starting to rise. We need to see the short-term yield starting to decline, and if they do that, then I think it's we closing in on that time. We don't see that. We're actually starting to see a decline in yield, the short-term yields. I just noticed, just looked into that this morning here, and I start to see the 1-year government yield and so on and so forth. They start to break some levels, and there's a nice neckline actually that it's breaking. And that could be the first sign of things starting to unfold, but we need to see a little more. And that is and yeah, the dollar, and everybody's so bearish the dollar. I'm extremely bullish the dollar. Not right here. I need to see it a little lower, but I'll be so bullish the dollar going into the final phase. And I don't think people really understand what that the wrecking ball, the dollar wrecking ball, is going to come out again.
Yeah, in Holland, the regulators are actually quite worried about crypto and how crypto eventually could also bring down the system because it's become so sizable. An earlier survey I saw from ING Bank said that in the age group between 18 and 54, one third of all Dutchies in that age group had crypto, and people owning crypto, half of their money was actually put into crypto. So it's becoming bigger and bigger. Do you also see that same risk? If could crypto bring down the stock market, for example, and usher in a complete bust of this mother of all bubbles that we're currently in?
So I think it's going to be the dollar that brings down crypto, that brings down, and stock markets. Again, it'll be about the dollar. Everything is about the dollar, and the dollar is going to bottom out, and I think we're going to see a top in that, which will go all the way to around 117, 120 on the Dixie. So it's quite a distance we got to cover there. And if I'm right on that, everything is going to be crushed. And I think, unfortunately, I mean, we have had bubbles so many times before in history. We have had the South Sea bubble. We have had the tulip crisis, also the tulip bubble. We have had the railway bubble. We have had the bubble in 1920s, the 2000 bubble, and so on and so forth. We have had so many bubbles, and the thing is simply that when it burst, you're going to see that a lot of people will have been dragged into it because of crowd dynamics, because of, this time is different. This is now the new shit, and you got to be in it. Unfortunately, this time we have seen a lot of support for crypto, and it's been around for quite long because of the easy money policies. So it has had around 10 years of runtime here, and people start to believe, this is now so it's part of the financial system now. I don't think it is. I think there's going to be, out of the thousands and thousands of crypto projects you have, that you're going to see that that it's only going to be a very few of those that are going to make it and become the next Amazon or the next whatever. It's going to be Google or something like that. But even those back in the days were also crushed into a phase where everything was declining. So I think you will have a few of the crypto projects, but it's not going to be as cryptocurrencies. So back to your question. Yes, I think a lot of investors now are actually piling on something which they don't really understand, and that they buy at ridiculously high prices because nobody understands which one is really the big one that you should hold on to. And 99% of them is going to crash and evaporate, maybe also disappear. So I think a lot of people can actually lose a lot of money. And if that's the case, and then in Holland, I fear it's the same in a lot of places around the world, maybe even more so in the US, where we also seen the US administration trying to push people into crypto on their retirement funds, which I think is lunacy, honestly. So I think we're going to see this having widespread problems into a lot of homes and families getting really hit hard by this. And I can only send out a warning here and saying I think people need to think this is a bubble, just like what they said. That's why I tried to mention the different bubbles here we've seen over time, and we will see it come crashing down, and you're going to lose money if you are not if you don't find a way to stay on the sidelines for some time at least, because of course there can be some good projects in the longer run, but it's not going to be all of them.
You work at Swissblog as a chief economist. That's a crypto wealth advising firm, right? So what do you advise your customers at the moment then when it comes to crypto, knowing that at some point it will correct heavily?
See, we have a fantastic framework, I have to say. It's not me who developed it. There are some quite good, strong, developers there, and people have been through the whole crypto. Actually, was in on the very beginning of the crypto phase here or period, and the framework is actually quite remarkable because it's been able to actually outperform Bitcoin. Just think about that. So it actually takes you in and out of the market on Bitcoin, and also understands when you need to get into altcoins and so on. And we just follow that. That's what we tell our clients also. So we tell them simply, we know that there'll be large declines and crashes even, but we also know that we need to listen to the framework, and that's what we do. And So that's also what we tell them. We tell them that there will probably be some volatility at some point, but as long as we stay true to the signals from the framework, we have a good belief in that we can actually weather this storm that's going to come on that. So that's how we say that.
So the framework is now still long, but recognizes when you need to sell the positions for your customers.
It's recognizing, when Bitcoin is moving in and out, and whether it's a Bitcoin phase, whether it's an Ethereum phase, or whatever, or it's an altcoin phase. So first, whether or not to be in crypto or not, that's really given by Bitcoin, and then and then when that is attracted enough capital, then we'll move into some of the other phases, and that's also what it tells us. And it'll also tell us, and now you need to get out. So it's actually doing that, and that's quite remarkable, and it's quite strong. So that's what we tell them. We tell them to stay on their toes, understand that this is there is a limited time for this, but it's also to let themselves support of by the framework, and be ready to move in and out as it tells us.
And how do you look at strategy, formerly known as Microstrategy? They have a shitload of bitcoins. Could once Bitcoin starts sliding and Microstrategy has to start selling Bitcoin in order to fulfill redemptions to their finance partners. How do you see that play out at some point then when things start crashing?
See, now you jump to an assumption that it has to drop. It has to drop below 70,000, I think, or something like that before.
But you said, like, in an earlier podcast, I think you mentioned Bitcoin would go to 16 or 17,000 or so.
Yeah, that would be on a good day. I think it goes lower than that anyway. Yeah. So, but you're right. I actually see. I think we have the largest open Ponzi game when it comes to MicroStrategy. It's just an open Ponzi game. Everybody needs to pile into him to the stock, and then he can take on some more debt, and he buys more Bitcoin, and he doesn't expect it to decline. And then if I get what I'm talking about with the 120 on the Dixie, I can promise you Bitcoin is going to take a beating. And if you see the largest bubble in the world, the Nasdaq, declining by 85%, which it did into the 2001 bubble after that, which is a smaller bubble than what we have today. Well, Bitcoin is going to have a really, really bad day, a bad period, and then that means that MicroStrategy is going to have that. So I think it's the largest house of cards we have seen in a long time, and if that starts to unwind, what you just said there, well, it's going to be really, really bad for people who think that can just hold on to it. I mean, I still see the case where it becomes so devastating on a societal level that lawmakers have to jump in and simply do something about this and say, well, we have to confine this, and you can't have this again. And I don't see a world in the future where if we get that kind of monetary reset that I think we're going to see, that any lawmaker actually wants to have kind of sideshows going on with Bitcoins and other cryptos that you can just spend and use as currencies. It normally was forbidden actually to create new currencies, and all of a sudden you have something here just popping out of thin air, and you have it all over without having what is really the regulation behind that. So I think there's going to be a lot of unwinding if this happens, and I think MicroStrategy is just a colossals on clay feet here. I think it can be really start to crumble if the Bitcoin starts to decline, and I'm not saying if, I'm saying when.
Well, governments and banks have done such a bad job managing our monetary system that it makes total sense that the markets come up with their alternatives, right? Whether it's Bitcoin, Ethereum, Ripple, gold, whatever. But I agree with you that maybe it's become so big that it will have devastating consequence for a lot of people if it breaks down. But of course, at the moment, the US is the crypto capital of the world, so I don't expect anything coming from the White House or Washington when it comes to coming up with consumer protection there.
No, me neither. Honestly, not at this point. I think there will need to be a lot of fallouts, and I fear actually for some of those fallouts, because if people have been told that they need to get into something and that just crashes into a deflationary bust, where are they going to turn their anger to? So I think I honestly think it's not a it's a bad situation also for people and the society. So if we will have to see how it all develops. If we're gonna get stagflation, which I think because of what the Fed could come out and do after when we see the deflationary bust, then I think you're gonna see that the only solution to that will be some kind of a monetary reset where you recreate or you reestablish sound money. And to me, sound money is about, it's gold you have behind there. It's about gold. It's about, having, show me yours and I'll show you mine. And then we'll look at the pile of gold we have and then say, and talking like countries here and say, okay, we need to settle, in a kind of a basket currency or new world currency or something like that, which may have a digital element to it, not Bitcoin, but a digital element to it, which means it's the checks of balances that will be by a blockchain, a ledger kind of thing that will then make sure that you can actually make exchanges across the world with that currency. See, that would be something. I mean, if you then you could have the Netherlands and Denmark and all, we could then peg our currency, euro now, but Denmark would then peg our currency to that, and the euro could peg its to this world currency, and then you could actually trade through that with worlds with people around the world on a basis also where the ownership of whatever is going to be bought and sold is going to be also sorted by the ledger and the blockchain. I could definitely see that, but it will have something of to go with the gold will have something to do with that whole monetary reset, and at that point there will not be room for a lot of other cryptocurrencies. There will be room for crypto digital projects where the blockchain is going to be the solution to something which creates real value in the real world, but not this speculation, this rampant speculation we have going on right now.
But it's interesting because you are a part of a crypto firm. So in a way, you also advocate for people to own crypto, but at the same time, you don't really see a future for cryptocurrencies, more for like blockchain solutions, but not so much for cryptocurrencies after the bust.
And how do I defend that? How do I defend that?
Well, it doesn't make much sense in my mind, then, right?
Well, I mean, you can be part of many things. You can be part of businesses where that you for some time you're going to see a decline in it, and there's going to be some kind of. I mean, I think gold and silver also are going to have a decline into the bust, and you could say, well, as long as you see that there is a technology behind it that is important, and that's what we can focus on for the future. For now, I mean, the crypto landscape has been developing for so many years, and they're also the ones, the Peter Schiffs and the likes, and just saying, oh, I just do not recognize it. I just don't want to look at it. I don't recognize it. And meanwhile, people have been making money, and we have to understand it's a zero-sum game. I understand that, but it's been part of the crypto, part of the financial world for such a long time. If I just disconnected from that and say, hey, I don't want to have anything to do with it. I rather dive into it and try to understand it, which is what I think I do now. And then I have also the macro side, which tells me that, well, probably this is a bubble and it's probably going to end badly, but it doesn't mean that there isn't something for the future there, like what with the internet. I mean, I could also have been part of a webwan or pets.com back in the days, and because I thought the internet could be something of a great thing for the future, and I want to get that kind of understanding. But you could see that the future did not hold a good situation for webwan or for pets.com, but there were lots of other businesses that actually did well on the internet, and the internet is defining the world today. So I think you disconnecting from it and just saying I don't want to be part of it is not the right way, and that's why I dive into it. But I'll say it as it is. I mean, WIF or Dogecoin and so on, they are memes. No, I agree. There's no technology. Yeah. It's just a joke. And
most of those projects are jokes and scams. I must agree with that. Can you explain again why a strong dollar is so difficult for most markets at the moment? And so when we see the dollar go up, how come so many borrowers, for example, get into trouble? Is it because we have the euro-dollar system where a lot of debt is in dollar, but a lot of people that have those debts actually get other currencies, and they will have difficulties refinancing? Or could you explain a little bit more why a strong dollar is going to wreak havoc on markets?
First of all, because if you have 60-70% of the debt in the world denominated in dollars, then when the dollar moves up, it's like everybody's being short the dollar. So it's a problem for people having debt in dollars, and that's the most debt in the world. And everybody will then see that the just to maintain the dollar debt will be something that is a difficulty. And then if you have to start restructuring your debt because your business is collapsing or something like that, well, then it'll become a problem because you have to demand more dollars, and then the dollar goes up even further, and it'll be a negative spiral. Then the other businesses will come into trouble, and countries will come in trouble, and you'll see that then they will have to also demand dollars to get that settled, and maybe they'll have to sell gold or sell something, bitcoins or whatever, to actually come up with the liquidity. And that's the problem. That's why dollar is it's really it's underlying everything. Yes, the euro dollar system is like a conveyor belt, and it's making sure that we are all connected to the dollar somehow. And if the dollar strengthens, then it's going to be a bad day for the world.
Yeah, you mentioned gold. We've seen in previous crises that gold also is hit and then recovers again. This time, of course, we have a lot of debt in the world, much more than previous crises. So it's still difficult for me to wrap my head around the thought that people would flee to debt as a safe haven, even though most of that debt is unsustainable. Looking at the Western nations and their high debt to GDP ratios, like for example, I cannot imagine people buying French government bonds, knowing that France might well need a IMF bailout as a safe haven. But explain to me what's gold role here is. First, we have the bubble, the bust, and then a stagflation. That's basically the trajectory you just described. How is gold going to perform during that trajectory?
Well, you said it into the 2007 situation. You had that gold started to decline as we saw the dollar shortage, the liquidity shortage started to play out. That was in March of 2008. You had the Bear Stearns situation, and really that started to push the dominoes, and you saw the gold actually declining by 35%, 33% from March of 2008 and until September, October 2008. And then when the Fed came in with the bazooka as well, then you saw something. The gold had putting in a big bottom and starting to rally, and you had the big strong rally into 2011, and then you had another problem, which was then the European situation, and then you had gold which came under pressure again, and so on and so forth. But what I think is going to happen again is that exactly the same. You're going to see that it will not be about investing. I think people say but where will I then see the money flow to? Well, remember, first of all, if everybody goes for the exit, first of all, in crypto, it'll be really big problem. You'll see that the first one might get the 110,000 for Bitcoin. The next one might get 109,000, but it's going to go down really rapidly as demand for money or for liquidity steps in. The same with gold. I mean, yeah, everybody's buying up gold now. The central banks and so on are doing that because they know that in a long time frame, especially in Asia, they understand that this can't go on. We need a sound monetary system, and it's going to end with gold at some point. But the thing is, there will be a lot of players and actors out there who will need liquidity, and by the end of the day, that is actually why you want to hold gold in many instances into a crisis, is because it's kind of a guarantee that you can get your liquidity that you need. It's the if you hold gold, you have liquidity. So that is why I think gold will decline, because it'll actually perform its finest duty, which is to supply liquidity into a deflationary bust. For the many institutions that are going to need that, and in the countries and so on and so forth. I think that is going to be the driver. But is it a fundamental thing? No, it's not. It's again about the cyclical and the fundamental thing. I think if you look fundamentally on gold, it's going to be, I see it into the 2030s going up to 35,000 easily. And that's because they are going to print a heck of a lot of money, more money to this. And prices are going to rise, and gold is an inflation hedge over the long time frame. So you are going to see gold going to rise as inflation starts to go up that ladder or start to rise, as I said. But in the shorter time frame, and this is what people need to understand, is that it can actually pull back quite strongly into a deflationary situation. And silver pulled back by 60% into the same period that I said before there. So it actually drops really quickly because it's liquidity. But of course, again, if you can sustain that and you think it's okay, well, then it's all fine. There is simply that phase where Dixie is going to be everything, as I see it, because of the liquidity shortage that will be when the floor opens up in a deflationary bust.
It's difficult to trade that, I guess. I mean, for you as an expert, you're looking at the charts the whole day. But like for an average Joe who perhaps has a bit of a spread portfolio with some shares, they own their own house, they have maybe some money in the bank and some crypto, some gold. Based on your analysis, would you advise an average Joe to then, if I summarize, for the next few months, ride the wave, then sell everything, stay in cash for a bit, and then go back into the market? Or is that even actionable for most people who have a job, who cannot spend the whole time behind their screens? Or should, like for example, when it comes to gold, I hold as an insurance. I don't trade it, so I just keep it. And I know it can go down for a year, 2 years, but in the end, it will go up again, especially given the high indebtedness across the world and the bazookas that will eventually be shot at the market. So would it make sense for an average Joe to trade that then?
Absolutely. I don't think the average Joe should trade this, but I just want to point out that what we could see, and again, it's better to know what's ahead than to be surprised by it. So if you're saying I'm fine with that, it's actually declining because I'm not going to need the money in that time frame. Great. And that of course is then I would support what you're saying and say, okay, then probably it'll be about, but it's just getting a little stretched here, Gold. I just want to say also it's been a little stretched here on the narrative of inflation's coming, which I don't think it is. So, but anyway, yes, to your question, as I said, 35,000 an ounce compared to what we see today is like 10 times up. I don't think that's to exaggerate. Actually, I think that is very, very plausible compared to the extremity in terms of the cash that has been injected to the monetary system over the last many years, and we need to see that. So I think that if people are saying, I just want to stay safe and I want to get through this, and I'm not going to need the liquidity, because that is the point. If you say I might need the liquidity at some point in this phase here because I don't know what happens to my house or I need to do something, well, then I'm not sure I'm going to hold gold. But if I can say with this 25% of my assets I will not need, well, then you may not do, you don't need to sell it. Then you probably can say, well, I'm just buy more if things are starting to decline. So I'll look at that like that.
Yeah. So we're about to wrap up, but just for me to just to make sure I understand it, also for the viewers, basically to summarize the different phases. So we first have the FOMO momentum. It will last a few more months. We will see exponentially higher prices especially in stock markets and in crypto markets. So people could anticipate to that. Then we would have basically a melt up. It will then come crashing down like big time, talking about 1929 .com style, also like 70% down, whatever. We see markets going down, so no bazookas would help against that. So the Fed and other central banks will
probably help to begin with. Remember, there's always a short time frame where people say, "Oh, now the help is here, the assistance coming in." But then you find out that they are actually pouring gasoline on the fire instead of water, and then you find out, wow, that's the problem, right? Because that will be the kind of the analogy for what they can do with they pump more money into that system.
Yeah. So the bubble phase is a few more months. How long is the deflation or deflationary phase with markets going down and also consumer prices sort of stabilizing a little bit?
I don't think the deflationary phase is going to be so long. I honestly think it can be quite short, and I'm starting to think maybe it has something to do also with the time frame of when the next Fed chairman comes in May of 2006, so 26, sorry, 26. That person coming in and maybe we could see some kind of a shift there. I don't know. Depends on when we see the top in the stock market also. But I don't think the deflationary phase can be needs to be so long time wise again. I think things actually can unfold rather quick. And there's also sometimes you see that the time the market takes to go up, and if I'm again suggesting that we could see this Eiffel Tower kind of top, you could also see it come down just as fast. And I think at some point when we reach certain levels, the Fed is going to panic and think, okay, now we have seen enough, and they come with their gasoline can and try to extinguish the fire with that, and then we're going to see something more. So I think the deflationary phase is going to be rather short. 6-9 months maybe, and then you're going to see, but it takes for the Fed actually to start daring to do it. The problem is already now, as we see that there are deflationary pressures on the economy, you see the labor market is not great, and still the Fed is hesitant. I mean, it's so it will take something for them to be convinced and say, oh, we actually can do this. And when they then do it, I think then you're going to see a bounce in the market. But then the next phase, the stagflationary phase that I see they can unleash is going to be longer, because there's no easy fix to that. There's no easy fix to a stagflationary phase.
No, because what could be a fix then?
That's the monetary reset. That's where you simply say, okay, we need to understand now that inflation,
like write down debt and
write down some debt. Of course, that needs to be done. We'll need to establish that and to make sure that people understand we will not just print money and all of a sudden they'll wipe out a lot of debt also on the US balance sheets and so on, and then things will start to unfold from there. And they will also run. You will see the negative yield real rates for some time, you see inflation will be higher than what the yields will be, and that means that you'll have real negative real rates actually, and that means that you're going to see inflation actually also eating some of this. It'll be all of these factors are going to play into it. So it's going to take some time for it all to unwind. The deflationary phase is going to be, I think it's going to be aggressive and fast, and then the Fed comes in, and then the next few phases are going to be the ones that will be more devastating. Stagflation is not fun.
No, and the deflation or the bust phase, you say is 6 to 9 months, but that's also when the Fed will dramatically, and all central banks across the world will dramatically lower rates, go back to ZERP basically, or NERP, and maybe even negative interest rates, and they will double, triple their balance sheets.
We'll have to see how far they get on that, because again, I still have that. We saw the bottom of yields back in 2020. It seems like that. So I think you are not going to see the yields pushing all the way down there. They probably want to do it, try to push it down as much, but I think inflation could show its ugly face faster, and that's why it's not going to be just the same thing. The days of the free lunch is over. It's not just going to be something like that. They just kick it all in, and then everything will be fine. I think they really fast will see, okay, this can actually lead to inflation, and they start to understand that can become a problem. Because if inflation starts to set in a time where you have the economy is also rolling over, which is stagflation, then a lot of people are going to be not very content with this, with everything. You lose your job, your stock portfolio, if you have any, is down, and you see prices on the groceries going up. I mean, not good. So that nobody will actually, no administration would like that.
But that will be very difficult water to navigate for central banks with high inflation,
Extremely.
But also no growth. I mean, there's no good choice then.
But imagine, central banks are not demigods. Just imagine. I mean, it's something that everybody knew 30, 40, 50 years ago. But over the last 10, 20 years, we all of a sudden thought, oh, Bernanke, the great,
the maestro,
whatever. No, the great maestro, that was Greenspan. That was Greenspan, the great maestro, right? And he was just magically, because he came from high yields kind of levels, and you could just lower rates, and we could
just lucky.
Liquidity. Yeah, he was in a good time there at that point. Yeah. Well, and then you have the poor folks there like Paul right now, who sits with the bucket of shit, right? So it's not going to be fun for those, and they are not demigods, and they cannot just magically create wealth. Wealth cannot be created from monetary policies.
Yeah. Final question, because that's something I always struggle with. Like, to what extent can the central banks also control the long end of the curve? Because, like, if you look at 30-year, the France 30 years just at a record high, I believe, or it hasn't been this high in a long time. The US, of course, also has high 30-year yields. People that want to lend to governments, knowing that they're all basically insolvent and can never repay the debt, are not willing, I guess, to keep on lending to them for low rates. So I expect these yields to go up, but you say you expect yields to go down, but also those types of yields, or more like on the short end. And can central banks actually influence the long end of the curve?
They can, but then they have to do all Operation Twists and whatever they call it, and they need to start buying up of those of the long end bonds. So they can suppress it, of course. They cannot do it with rate cuts, and that's a misunderstanding. Yeah. So I saw a lot of analysts. They need some kind of that. Yeah, what kind of they have all these tricks up their sleeves, and in terms of what they can do. But so they can. Yes, that's the question. That is the answer. But not with rate cuts. That will help the short end. But even the short end is something that is also set by the markets, which people need to understand. And the Fed will more or less follow what they see on the 2-year yield. So the thing is, the Fed and the central banks can have some power on that. But will in a world where inflation will start to move up, will be left with very limited tools, and I think that is the realization a lot of people need to get to at some point.
Great. Well, I found it very interesting, Henrik, to talk to you about all these matters. I think we've covered quite some ground here. Anything else you'd like to add?
Yeah, I want to say, I mean, I don't want to sound like a boomer or whatever you call it, and somebody that just I'm actually very, very positive in terms of what the human what we can do as humans in terms of technology advances and so on, like all these things. I think we're just making the same mistakes over and over, and that means that even though I think things are pretty dire right now, in terms of what we see in the stock market and in the financial markets, I think that we'll come through this. It will be tough, and there will be a lot of pain, unfortunately, but we'll get through this, and there will be fantastic, future. There will be AI is going to transform the world in a manner, we can't even, understand at this point, and that is going to be fantastic for our children and our grandchildren. But there will be some pain ahead, and please do not just fall into this that crypto is going to solve everything and Bitcoin is going to solve everything. It is not. So I want to say that.
Okay. Well, thanks so much, Henrik, for making time available. And hopefully we can do this again, maybe after the crash. Maybe every time we finish a phase, so the crash, the bust, and then we can catch up. Or
we can talk
ideally
again.
just
Absolutely.
before, so people can prepare. But thanks so much.
Thank you, Paul.
Yeah, and I put in the show notes where people can find you. It's on X, you're quite active, and of course a Swiss blog.
Yes, exactly. And
Great.
Also Substack. There's also one at Henrik Zeberg on Substack as well.
Perfect. We'll add it too. Thanks, Henrik.
Thank you very much. Have a good day. Bye.
Bye-bye.